Let me just tell you guys one thing before we get into this video. You guys are a very tough crowd, and by all means, you should be. If you see a title to a video like this one, you should question everything that is coming out of my mouth. Yes, the stock price of AMC has went down about 60% or more since November. That was not that long ago. So a lot of people, including myself, have lost money. And when you're talking about the worst case scenario, that's not something to throw around all of the time. When you're saying there's 100% proof AMC stock will rally from here, that's something, and that's a claim you have to have factual data to back up. And that's what we're going over here in this video. The literal numbers for AMC stock and how the price of AMC is undervalued at the current levels and that it will rally, like I just said. But the key is, will that cause a short squeeze? Will that cause a gamma squeeze? Will that cause something else to happen to make the share price go up to $1 million per share? I'm not sure on that. I'm not trying to go over that here in this video. We have plenty of videos for that. This is for really the worst case scenario, how you are already under that worst case scenario, how the fear is really taken over, and why it's a 100% fact AMC is going to rally from these prices. To how high or when, can't tell you that, especially not here in this video. That is the quick disclaimer here. That's what you guys need to know heading into this video, and that's what we are going to cover here in this video. But before we start crunching the numbers, hit the like button, subscribe to the channel, and comment down below so this video is pushed out to as many people as possible and they have an opportunity to watch this video as well, because I think it'll serve a large majority of the current community very well by watching this video. So you're also helping out your investments by doing that. Let's see if we can get to this video to 500 likes. Let's see if we can do that. That's a challenge for you guys. Thank you guys that went ahead and did that. And if you want to support the channel in a greater way, links down below in the description for Webull, Moomoo, and Public to get yourself some free stocks. Definitely take advantage of that. Free money, help support the channel. It's a win-win for everybody involved. As well as that, if you want to come join the trading community, link down below in the pinned comment, and go ahead and follow me over on Twitter as well. Now, first thing that you guys need to know is that AMC has not been a good fundamental business ever. Never. It's never been a good business. Let me drop that bombshell on you guys. It's never been a good business, at least in recent history. Going back pre-pandemic, which those should have been the best numbers they've ever had, which they were the best numbers, but the profit margins were ass. AMC made no money, like literally $0 most years. Most years they lost money, and you can see this by taking a look right here. The green is the revenue, the blue is the earnings. This is everything after all expenses are paid. This is what AMC actually made, profit. In 2018, $5.46 billion of revenue, $110.1 million in pure profits. Now that right there, you could tell, very, very low. Take a look at something like MP Materials. They made about 30% profit in 2021. Now I know there's a lot of differences there, but let's compare AMC's pre-pandemic levels to Cinemark, the other publicly listed larger movie theater chain, right? AMC's number one, Cinemark number two, and then you have Cineworld, and then you have the other guys under that. So let's take a look at their numbers. What were their numbers? In 2018, $3.22 billion in revenue. In total earnings, net profit, that was $213.83 million. Now, just looking at that, that is better than AMC. But let's actually do the numbers, because granted, I crunched the numbers for you guys to make this simple. So in 2018, Cinemark had about 6.6% profit margins, 6.61% profit margins, to be more specific here. Now let's take a look back at AMC. AMC, again, did $5.46 billion of revenue and $110 million of pure profits. What kind of profit margin did AMC have? Well, they had about a 2.72% profit margin. So 3 times smaller of a profit margin than Cinemark. So AMC by a book value there, considering the fundamentals here, Cinemark would have been a much better buy, about 3 times as profitable. So big difference there. But what about the slightly worse year for the movie theater industry, for both companies, for all companies? 2019 was not the best year for movie theaters. AMC had $5.47 billion of revenue. They lost $149.1 million that year. Lost. Net loss. In 2019, Cinemark did $3.28 billion of revenue and made $191.39 million of pure profits. And the actual profit margin for 2019 for Cinemark was about 5%. So they lost about 1% profit. Big deal, right? What did AMC do? AMC had previously in 2018 made a profit of 2.72%. In 2018, they lost 2% flat. That's a big deal. That's a bigger deal because you're losing more money. But nonetheless, why is that a thing? Why does Cinemark do better than AMC in good years and AMC does worse than Cinemark during bad years? Why is that happening? Well, it's simply put that AMC has been around for much longer than Cinemark. So Cinemark had a geographical advantage there by getting theaters in good locations. AMC has a lot of their theaters that especially they have shut down in the past year and a half. A lot of them were old theaters that were not as profitable from this period. From the 40s, 50s, 60s, 70s, sure, they've changed them up, but geographics change. Things change. So a newer theater is going to tend to do better. It tends to get more location preferences. You know, what was big in the 40s and 50s, 60s, and 70s, not necessarily big today as far as city size and where locations are at. Hopefully that makes some sense to you guys. So those losing locations really start to drag down your bottom line. But that is why the net profit is so important. And let me be the first one to tell you guys that the market makers know exactly what prices of these stocks that they are shorting is actually worth on a fundamental basis using the price to earnings ratio like we are right now, price to sales, the PEG ratio. There's a ton of ways to value stocks. These algorithms know exactly what the fair value is. And once you see the markets become more accommodative, you start to see these uncertainties that are gone, like Russia, Ukraine, the inflation situation, clarity with the Fed and getting into possibly a rate hike cycle or even a recession. Movie theaters, they don't care. They still do fine during recession. People still go to the movies, believe that or not. But besides that, let's look into the future. What is going to happen into the future? That's what we want to know as investors. We buy stocks because hopefully they will be worth more in the future. And we're going to go off of the pre-pandemic numbers. Let's say $5.5 billion of revenue the company makes, right? Let's just say that. And let's say they can make a 10% profit margin. That would be higher than Cinemark, but AMC is also doing a lot more than Cinemark. They are getting into more of their on-demand. They're going to do credit cards. That's a huge profit machine. AMC branded credit card, dude, that's huge. Like Adam Aaron said. Plus everything they're doing with NFTs, crypto, different events. They're going to be selling apparel. They're going to be doing a lot of different things. The popcorn business, 80-90% profit margins. So let's just say AMC can reach a 10% profit margin, as well as they're raising ticket prices, all of that. There's a lot they can do, especially because higher inflation goes, the more AMC can raise prices, and people don't even care about it. So let's consider 10% profit margin. That's $550 million of pure profit that AMC would make. Now, if you divide $550 million of profit divided by 513 million shares outstanding, you come up with earnings per share EPS of $1.07. Now, if you take the share price of AMC, assuming by the time you guys see this video, it's $14 per share. Type in different numbers here, doesn't matter too much. EPS, by my calculations, $1.07, and we will divide that by the current share price, or divide the share price into EPS. When you do that, you come out with a 13 price to earnings ratio. Is that high? That's the question here. And that is only assuming that AMC revenue stays the same. That's not to mention if we see a $7 billion revenue year, which is more in line with what I'm really expecting, possibly higher than that. It could approach $8, $9, $10 billion of revenue this year. Time will tell. We will wait and see on that note. But what's a normal price to earnings ratio? So it says investors tend to prefer using forward PE through the current, though the current PE is too high right now at about 23 earnings times. I think that was for an article or something. I hate how Google does this, but it says there's no specific number that indicates expensiveness, but typically stocks with PE ratios of below 15 are considered cheap, while stocks above about 18 are thought of as expensive. And it depends what kind of business you're in. Especially if AMC does start to grow into much more than a theater trade, the markets will be forced to accept a higher PE for AMC stock. If they're getting into credit cards, if they transform the business. Like Adam Aaron said, you will not think of AMC as a typical theater business. That implies some very big things to come. And unfortunately, we don't know exactly what they are going to do, but only time will tell on that aspect. But what I know from the numbers right now is it looks like we're really at that fundamental valuation. And that's why I say what I say. During times of insane fear and volatility like we have seen lately in the last really month and a half, you can see the price go under a fundamental valuation. But like I said earlier, the market makers, they know that fundamental valuation. So once Fed Jerome Powell gives us clear guidance on what he's going to do for the economy, once we get lower inflation, once we see Russia, Ukraine, this war ending, like I said, we're going to see the stock rapidly adjust to that fundamental valuation. You will see short squeezes in the markets like you have not seen in a very long time. And that's why I'm so excited about what I am going over with you guys here in this video. When it comes down to the MOAS, I think that's self-explanatory. That we've covered that a lot. So this is just an added bonus, and that could happen and will happen very fast and very unpredictable. It'll be one day Fed says a statement and everything starts to rally. That's how it could be, or it could be a ceasefire. It could be anything along that realm that gets rid of most of the uncertainty, which is probably Russia and Ukraine right now. That's when you're going to see everything go crazy. So that is going to be all for this video. Hit that like button and subscribe to the channel if you guys learned anything here, got a good insight, whatever the case is. Let me know your thoughts as well down below in the comment section. Thank you guys for going ahead and doing that. Get yourself free stock, link down below in the description as well for Webull, Moomoo, and Public. And if you guys want to join the trading community, link down below in the pinned comments. I think I'm starting to get sick, so I appreciate you guys for being here yet again. You guys enjoy the rest of your day, and I will see you in the next one.